starting with baggage. What do we understand by the term baggage? If you ever have happened to go out of India, in that case, when you come back, you would have seen this kind of a sign of baggage. Baggage, whatever you are bringing from outside India in your own baggage only. Means not from the official route, like I'm not just importing something from air or vessel or something like that. I just went and I brought things along with me only. So baggage, but baggage also includes unaccompanied baggage. Now, what is the meaning of unaccompanied baggage here? So let's say Rihanna. Rihanna just now came to perform at the Ambani wedding. Yes. Now Rihanna had a lot of stuff along with her. So let's say in that case, she came separately and then her baggage came separately before her or after her. So she arrived today. Baggage might have arrived today only, tomorrow also, or before her also. So that is, nobody is accompanying that baggage, right? Nobody is accompanying that baggage. Baggage is coming separately, person is coming separately. So that unaccompanied baggage will also form part of baggage only. Just that motor vehicle can never be considered as baggage. Other than that, be it accompanied baggage or unaccompanied baggage, both of them are considered as baggage only. Now, whenever you come to India with a baggage, you will have to fill a declaration named as baggage declaration form. And you yourself will only say, I have brought this things to India, and therefore whatever duty applicable you can charge from me. So baggage declaration form, you will yourself declare whatever you have brought to India in this declaration form. This I'll explain you later. Now, bona fide baggage. See, bona fide baggage simply means my own clothes I am bringing, my own clothes, my own used articles, anything like that I am bringing. Then to, of course, or any small gift for my family, friends, any souvenir. Let's say I went to travel Paris. Now, of course, if I've been to Paris, how can I come without small Eiffel towers for my friends and family? So those kind of small souvenirs, your own used clothes, your own used articles are all exempted. They're all bona fide baggage. So no need to pay duty on these things. No need to pay duty on your own bona fide baggage. Then on what should we ideally pay duty? Passenger baggage rules. Passenger baggage rules, rule 3. Understand, for people who are Indian residents or people of Indian origin, Indian resident or even a foreigner residing in India or a tourist of Indian origin, basically you have roots in India. Either you are Indian or you are a foreigner but you reside in India, or you are a tourist of Indian origin only. In that case, excluding annexure 1 item that I will teach you in 5 minutes, you forget, you ignore, you exclude annexure 1 item. Other than that, whatever other items you are bringing, up to 50,000 you can bring them duty free. This is known as GFA, general free allowance. This is a general free allowance that if any person is going outside India, coming to India, he will bring something. No, today if I'm going to travel somewhere, I will bring something from there which is very much normal. Stop charging duty on it. It is very much in a good intention, bona fide intention. So up to 50,000. Up to 50,000, it is general free allowance, general for everyone, whoever are person of Indian origin or Indian residents. If you are tourist of foreign origin, in that case, your general free allowance will be 15,000, again excluding annexure 1 item. But if you are an infant means a child up to 2 years, then you do not get any general free allowance. If you are a child up to 2 years, then only your used articles, your used clothes, your milk bottle, etc. will be allowed duty free, but not a single rupee thing you can bring extra and form it as a part of general free allowance. So whatever you are bringing in the name of an infant or a child up to 2 years, everything will be taxable under baggage. This is applicable for passengers arriving from all countries except Nepal, Bhutan or Myanmar. Understand, Nepal and India are landlocked countries. Every day I can go to Nepal, every day I can bring 50,000 goods duty free from Nepal and start selling in India. This can become my normal business. So of course, if you are coming from Nepal, Bhutan or Myanmar, then these are not the GFA applicable to you. Then we study separate rules. If you are coming from any country other than Nepal, Bhutan and Myanmar, being Indian people, you get 50,000 general free allowance. Being foreign tourist, you get 15,000 general free allowance. Being infant, you get nothing. What do we understand by the term tourist? Same. Entering India for a legitimate non-immigrant purpose for 6 months in the period of 12 months. Right. Now, if I am coming from Nepal, Bhutan or Myanmar, except land route. See, understand. If you are coming from Nepal via land route, you do not get any GFA. Not in rule 3 also, not in rule 4 also. If you are coming via land route from Nepal, Bhutan or Myanmar, you get no GFA. If I am coming other than land route, let's say I have taken a flight from India to Nepal, Nepal to India. In that case, I will say rule 4. Be it Indian person, be it foreign person, for any passenger, 15,000 baggage general allowance only applicable, infant again nil. So to summarize everything, if I am coming from any country other than Nepal, Bhutan, Myanmar, any route, it will be 50,000 for Indians and 15,000 for other. Coming from Nepal, Bhutan, Myanmar via land route, zero baggage general fee allowance. Coming from any other route from Nepal, Bhutan, Myanmar, 15,000, be it Indian, be it foreign, any passenger, 15,000 limit is only applicable. Is this clear to all of us? Say yes or no. What is this cloud saying? You cannot pool GFA for 2 or more people. You cannot club or pool GFA for 2 or more people. What do we understand by this pooling? Let's say Mr. Yash, Mrs. Let's say Mr. Yash Patel and Mrs. Seema Patel. They are both husband and wife coming along with their infant 1-year-old child. Okay. What they've brought is used clothes, 70,000. Then let's say they have brought a new mobile phone for 1,25,000. And they have brought, let's say, some another normal stuff. Other items, other stuff, or okay, or they've brought some souvenirs. They've brought some souvenirs, small gifts for their relatives for 1,000 rupees. Now tell me, and we can reduce GFA out of it. What will be the amount on which duty will be applicable? Tell me. This is the question. 3 people are coming. You need to tell me the amount on which duty will be applicable after reducing general allowance. Patel, they are both Indian people only coming from USA via air route. Chalo, tell me. We will solve questions. This is just for understanding for now. See, used clothes, I will have to ignore. Bonafide it is. Travel souvenirs also I will ignore. Now I have 1,25,000. Should I do it this way that Mr. Yash will have a 50,000 GFA? Mrs. Seema will also have a 50,000 GFA. So 1,25,000 minus 50k minus 50k on 25,000 I will charge my baggage duties. Will I do it this way or 1,25,000 minus only 50,000 GFA I can do and 75,000 I will charge my duty. Travel souvenirs and used clothes anyways bona fide intentions are not leviable to duties under baggage. So option A 25,000 or option B 75,000. Very good. The answer will be 75,000. We are simply saying one item can be cleared by one person only. Either Mr. Yash uses his GFA or Mrs. Seema uses her GFA. That is not a problem here, but you cannot say that this person has 50k limit, this person has 50k limit. Let us club both of them and then clear a single goods. Let's say here they had brought one mobile and they also brought one calculator. Calculator is for 5,000, mobile is for 1,25,000. In this case, we can say that Mr. Yash can use his 50k GFA and pay duty on 75,000 and Mrs. Seema can use her 50k GFA and not pay any duty on calculator. That is okay. 2 separate goods can be cleared by 2 separate people. But one single article that you are bringing, you cannot pool your GFA to clear one single item. Say yes or no, everyone. Understood? Done, ma'am. Now talking about jewelry allowance, which is in addition to the normal rule 3 and rule 4 allowance that you get. So if at all your period outside India. Your period of stay outside India is more than 1 year. If see your period is less than equal to 1 year, you do not get jewelry allowance. Jewelry allowance is only and only available. Jewelry allowance is only and only available if you are a passenger residing abroad for more than 1 year. If you have resided abroad for more than 1 year, in that case, you normally get your Rule 3, Rule 4 benefit. In addition to that, like even if after I have exhausted my 50k or my 15k limit, depending upon from where I am coming or who I am, if I have already exhausted my 50k limit from Rule 3, Rule 4, I can also take additional benefit of Rule 5 in the name of jewelry allowance. If I am a gentleman, in that case, I can bring jewelry up to 20 grams with a value cap of 50,000 and exactly double for a lady passenger 40 gram with a value cap of 1 lakh. See, understand, jewelry means jewelry. Jewelry means jewelry. If you are bringing gold coins, silver bars, that is not jewelry. That is not jewelry. They are basically annexure 1 item taxable fully. So we are saying for items other than ornaments. This is particularly only for jewelry, which is in the form of ornaments if I am bringing. Let's say I am bringing any coins, bar, biscuits, etc. There the full amount duty will be leviable because annexure 1 items. Firearms, cartridges, alcoholic liquor, gold, silver, other than ornament, any form. Full applicable duty, applicable rates, duties are applicable. So this jewelry allowance, first of all, make sure is available to you only when period of stay is greater than 1 year, and also if it is in the form of ornament jewelry and not in the form of coins, bars or biscuits. Done. Now you have to check both gram limit also and value limit also. Let's say Mr. Jain and Mrs. Jain have returned to India after 2 years and they have already exhausted their full 50,000 GFA. Full GFA according to Rule 3 they have already exhausted. Along with this they have also brought some jewelry. Mr. Jain has brought 18 grams of jewelry and value is 52,000. 18 grams of jewelry. So gram limit, if I say 18 is less than 20, that is okay. But the value for jewelry is 52,000 and maximum value that I can bring is only 50,000, which means on 2,000 duty will be required to be paid. But let's say Mrs. Jain brought 45 grams, value only 45,000. Value is less than the limit of 1 lakh, but gram wise, weight wise, 40 gram is only allowed and she has brought 45 gram. So if 45,000 is the value of 45 gram, what will be the value of 40 gram? 40,000. So what is in excess? 5,000. Duty will be payable on 5,000. So you will have to check both the things, weight wise also and value wise also. If it is more value wise, then I will take the value limit. If it is more weight wise, then also I will have to take C. You cannot say that 45,000 is less than 1 lakh only. No. But then 45 gram is greater than 40 grams, of course. So proportionately for 5 grams, duty will have to be charged. Your jewelry should be less than the 40-20 grams, should also be of value less than 50,000 or 1 lakh. Then in that case, we say that no duty will be leviable on it according to the benefit of Rule 5, which is jewelry allowance where period of stay should be greater than 1 year and it should be in the form of ornaments and not in the form of coins, bar or biscuit. Mobile, I was asking new mobile, not a used mobile of the passenger in the example that I had taken just now. Mobile 1,25,000, I meant a new mobile that I've purchased and I'm bringing, not my used mobile. Chalo. Very good. Now coming to the main part of the chapter, which is computation of customs duty. Main part of the chapter, computation of customs duty. So first of all the used articles, all the travel souvenirs, bona fide purpose, and one laptop if your age is 18 or above. If you are a person of the age 18 or above, you can bring laptop. You are now an adult because you are 18 plus. You can bring laptop, watch whatever you want on the laptop. Nobody is going to stop you without any value limit. It is exempted from import duty. If I am a person, let's say my age is 23 and I have brought a laptop for 1,67,000. There's this another person bringing a laptop for 37,000. No problem. Forget the value limit. If your laptop is even for 10 lakh rupees, no problem. We are going to exempt your laptop in the baggage. And travel souvenirs for bona fide purpose. Understand? I went to Paris and I brought 1,000. I brought 1,000 Eiffel Towers so that I can come here and start selling them. Now it is not a bona fide purpose. They are not travel souvenirs anymore. They are now my normal goods. Then duty will be chargeable. But I have 6-7 friends and I brought small gifts or chocolates or a small Eiffel Tower keychain for them, then of course it is a travel souvenir and it will be duty free. So used articles, travel souvenirs, and one laptop. If your age is 18 plus, let's say there's this person whose age is only 15 years coming from USA, bringing MacBook, bringing laptop, then it will not be exempt. Why? Because his age is not 18 yet. Okay. Now after ignoring these items, because no duty on these items, for all the remaining things, I will make a total. I will reduce my GFA according to rule 3 or rule 4, be it 50,000 or 15,000, and then whatever I am left with on this amount, I will charge basic custom duty 35% plus 10% social welfare surcharge, which comes to 38.5% on this figure. This is the benefit of baggage, that you forget your actual custom duties, whatever are applicable. If you are bringing something in your baggage, you exclude these things. Other than that, you make a total of everything, reduce your GFA, no duty on GFA, and for the remaining amount, 38.5% will be the duty payable on baggage. Say yes or no, everyone. What is this? Give me 2 minutes. Now, Annexure 1 items cannot be included in GFA. Annexure 1 items cannot be included in your general free allowance. What are these Annexure 1 items? If you are bringing firearm, cartridges more than 50, which means if I am bringing cartridges for firearm less than or equal to 50, I can include them in general free allowance. Let's say I got 60 cartridges for a value of 6,000. Up to 50 cartridges for a value of 5,000, I will include in GFA. And on the remaining 10 cartridges worth 1,000, 100% basic custom duty along with 10% social welfare surcharge will be charged. And proportionately for 50 cartridges, I can include them in my general free allowance. Also, CCT, cigarette, cigar, tobacco. Cigarette 100 stick, cigar 25, and tobacco 125 gram. So up to 100 sticks of cigarette, up to 25 sticks of cigar, and up to 125 grams of tobacco, you can include in your general free allowance. Anything above that, just like cartridges, 100% basic custom duty and 10% social welfare surcharge will be charged. Alcoholic liquor, wine, up to 2 liters. Up to 2 liters will form part of general free allowance. More than 2 liters, again, whatever according to HSN code are the normal applicable duties on wine. If given in question, take that. If not given, then no option left with us. We'll have to take 100%. So they are saying, if ornaments you are bringing, ornaments you can take benefit here in general allowance, and also you can take additional benefit in rule 5. But if you are bringing gold, silver in any form other than ornaments, raw gold, raw silver, again applicable rate. If question is giving you applicable rate, take that. If no, then otherwise no option is left. You'll have to take 100. And last is flat panel. Some years prior, there was this sudden increase in the import of television. Everyone going abroad bringing TV, LED, LCD, flat panels. So government put it in the general free allowance list only, that if you are bringing flat panel, LCD, LED, or any kind of television, then also it will not form part of baggage. And on the applicable rates, if given in question, you will have to charge your customs duty. This is how you make computation of customs duty under baggage. Simply, I will take everything. Cigarette up to 125, 125. If it's more than this, then it will form part of Annexure 1 item. All the other articles, I will make a total, reduce my GFA, and charge customs duty at the rate of 35 plus 10 SWS, which means 38.5%. Transfer of residence you can self do, because this is particularly C category, never asked in examination till date. I'm not saying it cannot be asked, might get asked. If I'm importing or exporting currency, then of course Foreign Exchange Management Act, FEMA. According to the provisions of FEMA, I will deal with the currency. Unaccompanied baggage, I've already explained you. Passenger is coming today. Baggage can come after her or him within 1 month, or before him or her within 2 months. It is all considered as a part of baggage only. So passenger is coming today, unaccompanied baggage can come after 1 month, or additional commissioner, deputy commissioner can also grant extension after 1 month also. Before 2 months also it can come. And again, additional commissioner, deputy commissioner can give extension, but it should not be total 1 year. Extension cannot be like You cannot send your baggage even 1 year prior to when you are coming. After you come, there is no limit on extension. But before you are coming, maximum 1 year back, we can go. So when the date on which you are coming, normally 2 months before you or 1 month after you, your baggage should come. After extension is possible as much as commissioner wants, but before extension is only possible maximum up to 1 year. And all the baggage rules that apply normally, rule 3, 4, 5, whatever we are studying, that apply to baggage will also be applicable to unaccompanied baggage as it is. And then crew members, let's say we are crew members normally traveling every day. If we start to get baggage general allowance every day of 50,000, 15,000, then the people can start doing business. So if I'm crew member on duty, then only simple 1500 baggage allowance is available to me, that too normal chocolate, cheese, or small gift or cosmetic, something like this. Small gift item, cosmetic, chocolate, cheese I can bring for me and my family up to rupees 15,000. Other than this, normal import duties will be applicable. But if I have been terminated from job, now I am no more a crew member. Last journey done, now I am no more a crew member. Then so of course, as the normal baggage rules apply to normal people, will be applicable to crew members also. And then last part is temporary detention of baggage. What is the meaning of temporary detention of baggage? So if your baggage, let's say I am coming from USA to India at this port. I will stay for 10 days in India and then I will leave India and I'll go to some another country. I have brought, let's say, wine or some other articles with me that are normally prohibited in India or normally are chargeable at some higher rates of duty in India. Of course, I don't want to consume these goods into India. I don't want to actually import these goods into India. What I can do is, at this place when I'm coming, I can tell the officer that, see, I am not at all intending to clear these goods into India. It's just a 10-day stay that I will stay in India and then I will leave India and go to some another country. So if you want, you can detain my goods. And whenever I leave India, you give these goods back to me. And if it is not possible for me to collect, I will authorize a person to whom you can send. Or you can also send me these goods as a cargo also. This is known as temporary detention of baggage. And in such case, this person can save himself or herself from duty being applicable because he is not importing the goods into India. So we are saying if your baggage contains any dutiable or prohibited goods, the proper officer may, at the request of passenger, detain article and return it to him on his leaving India. If passenger himself is unable to collect, he can return these goods as cargo or also through authorized passenger. So starting with the chapter of types of duty. The chapter you are going to find is huge in terms of length, but yes, if I show you the question answers, there is some repeated kind of questions being asked all the times. So after entire chapter I have given you this format. Now see, this is not from the module, but this is what will be useful for you in examination. I would call it a chit page, right? So I've told about few chit pages to you already. If not able to remember, just share this page and take it along with you in the examination. So after we study everything, what would be most relevant for you would be this format that I'll discuss with you, and majority of the questions you will be able to solve with this format only. And most of the times it is practical question only which comes up from this chapter. There's a lot of theory given, but theory is as such not that important. So let's just quickly go through the theory once and then solve questions. Types of duty under customs. Okay, so we understood that Customs Tariff Act has first schedule and second schedule. Already I've taught you this in the chapter of classification, that the first schedule is with respect to the rate of duties of import of goods, and the second schedule is with respect to rate of duty on export of goods, right? So generally, this also I've taught you that generally always the standard rate of duty will only be applicable. But for cases where we are supplying to certain notified areas, we'll apply the preferential rate of duty. Now, to apply the preferential rate of duty, which means less duty as compared to the standard duty which is given in the schedule, we have to specify we have to satisfy 4 conditions. Condition 1 being, we have to make a claim for preferential rate. See, you do not get anything without asking. You do not get anything without asking. So if at any time you want to take the benefit of preferential rate of duty, you will specifically have to make a claim for it, that yes, we are availing benefit of preferential rate. Second, those goods are produced, manufactured in such preferential area. As I said, we have MOUs with a lot of countries that if we import from those particular notified countries, then only we are allowed to pay less taxes as compared to the normal standard taxes, which we call as the preferential duties. So you need to make a claim that yes, these goods have been manufactured or produced in those preferential areas which are being notified. Third, whatever area you are showing here, that area actually has to be notified. So first of all, let's say I'll make a claim that my goods are manufactured in China, let's assume. Now China may be a preferential area, might not be a preferential area, we don't know. Just take an example that, okay, here I said, first of all, I made a claim that I want preferential rate of duty. Why? I've imported goods which are manufactured in China. Now I will make sure and make a claim that this area is actually notified. China is actually notified as a preferential area. And last, that origin should not be changed. See, it should not happen. It should not happen that, say for example, USA is a notified area. We have an MOU with USA that if we import goods from USA, in that case, preferential rate of duty will be applicable. We do not have an MOU with China. Means China is not a preferential area. Now what people do, ultimately the original manufacturing place is China only. We first export the goods from China to US and then import the goods from US to India, just to show that we've imported from the notified areas and to claim the benefit of preferential duty. So here government is saying that the origin of goods has to be determined using rules. You cannot shift the origin. Just to claim the benefit of preferential rate of duty, I cannot shift the origin. I will actually have to prove that yes, US is the only area where it is being the goods are being manufactured. It is the origin area of the goods, and also that particular place is a preferential place. So I need to satisfy these conditions while making claim. I need to say from where I am importing, whether that place is actually a preferential area or not, and also I need to prove that the origin has not been shifted. If I am able to fulfill all of these conditions, I can claim benefit of preferential rate of duty for certain notified areas. Right. Now we start understanding what are the various types of duties being levied under customs. So first of all, the most basic is the basic custom duty. So whenever you import or export any goods, government has specified basic customs duties with respect to same. That this will be the duty applicable, 10%, 20%, 30%, 40%, whatever is the basic custom duty. Now it is levied on all goods imported, exported. Why? Because the taxable event under customs is import and export. Now it may happen that government has exempted certain things, like for exports. For majority of the exports, government is not levying any duty only. Duties have been specified in the Customs Tariff Act, but it is on government to anytime give exemption with respect to same. But basically what we have to study is that on all goods imported and exported, either on transaction value or on tariff value. This we are going to study in the chapter of valuation. See, transaction value simply means on what exact transaction amount I am importing goods. Say for example, so say for example, I import calculator. I import 100 calculators and every calculator is worth 3,200. So this would be the total transaction value for which I am making imports, and duties will have to be paid on this. Or for certain notified goods, government has given tariff value. Say for example, I import gold. Now you might import gold on any rate, we don't know. Government has specified a tariff value that if you import gold, for every kg of gold, this is the value that we are going to take. That is known as tariff value. So it might be on transaction value or for certain notified goods where government says we are least concerned about what is your actual transaction value. We will be levying customs duty on the tariff value only. So whatever is the transaction value or for certain cases tariff value, on that particular amount we are going to levy the basic customs duty. Right. Now there are some countervailing duties, not very much important from examination point of view. They never come. In fact, excise duty, sales tax, VAT. Now what they are saying, see, if we manufacture certain goods in India, in that case we have to pay excise duty. For some specific goods like the NAP products, alcoholic liquor for human consumption, tobacco, we know that excise duty still continues. Now, if I manufacture in India, excise duties are being levied. But if I import from outside India, and government is not levying excise duty, then there would be a I would say disbalance. Why? Because manufacturing in India would become costlier owing to excise duty, but importing would become cheaper because excise is not being levied. So just to countervail that and make both of these equal and comparable, government levies countervailing duty for excise under customs also. So today if I import certain goods, which if I manufacture in India are liable to excise duty, then on imports also I will be required to pay customs duty on the same. So an additional duty to counterbalance the effect of excise duty, like the alcoholic liquor, tobacco, we know for which of the products excise continues. Same goes with countervailing duty under sales tax or VAT. So for any particular goods where currently sales tax or VAT is being levied, to counterbalance that particular thing in case of import, we also levy sales tax and VAT there. And the maximum rate can be 4% for this countervailing duty under sales tax and VAT. Now, this is what comes in examination, which is countervailing duty for GST. Now we know that GST is applicable on majority of the goods. So if I manufacture certain goods in India and sell those goods in India, I know that I'll be required to pay GST on the same. But if I import certain goods and I do not levy GST, it will make the imported goods cheaper. Therefore, to counterbalance the effect of GST, government is saying that we treat always import and export as interstate. In all the cases, import and export are treated as interstate only, and therefore IGST will be levied. And we know maximum rate is 40%. We've studied this in IGST Act also, that the maximum rate which can be levied under GST would be 40%. And here, on what value am I required to levy GST? This also we know. The whatever will be the transaction value, assessable value or tariff value as per Section 14 of Customs Act, and plus all other customs duty excluding GST. On all this, I guess one question like this we had done in yesterday's session, where we took the assessable value, added customs duty in that particular value, and then GST was levied on entire assessable value as well as customs duty. Because GST, the value of supply chapter of GST also says that except for GST and TCS, we will be levying GST on all the taxes which are in relation to that particular transaction. Right. Then bond-to-bond transfer, we've already studied in the chapter of import-export under GST, where we say that the customs duty will be levied on the original imported assessable value, but GST will be levied on that original transaction value or that transaction value between bond-to-bond buyer, whichever is higher. So value for levy of IGST when goods sold in warehouse before clearance for home consumption would be the value determined under section 3.8, means the transaction value as per customs, or the transaction value of such goods whichever is higher. If sold multiple times, if we sell multiple, means the goods are lying in warehouse only and we are selling multiple times, then we'll be comparing with the last transaction value and the value determined by the original Customs Act. For part goods sold, which is very much simple, if I import 1000 units and while the goods are in warehouse, I sell only 300 out of it. For 300, you do this proportionate calculation. For remaining 700, it is fine. Whatever will be the original customs duties will be paid. So this one-to-one transfer we've already covered in the chapter of imports under GST, and the same thing I had taught you there also. Now we understand that for certain goods, we also levy GST compensation cess for certain thin goods and for certain luxury goods. So same applies here, that if I import those goods, then to counterbalance the GST cess, we will also be levying CVD under customs. Okay. Again, the value for the value for GST cess would be that same transaction value plus all other taxes except GST. And bond-to-bond transfer may be in bond-to-bond transfer also, if those particular goods are leviable to GST compensation cess otherwise, then in bond-to-bond transfer also we'll be levying GST compensation cess. So these are all about the duties that are being levied. Now what is most important for customs would always be the basic custom duty, means the duties that you are going to see in examination 99% of the times would be basic custom duty plus social welfare surcharge that I have taught you. That even if the question says or do not say, you mandatorily always have to levy social welfare surcharge, and then on entire amount we will be levying GST. In 99% of the questions, this is what we are going to do. Now, other than that, there are certain safeguard duties, protective duties, which only specifically the question from types of duty come, then only would be applicable, not in other valuation or other chapters. Means It may be there in the question, but normally it is not asked in customs. Okay, so this is all. Now see, there are hardly 4 or 5 types of goods on which excise or sales tax is being levied, right? So the chances of countervailing duty under excise or sales tax or VAT appearing in examination is extremely low. But yes, GST CBD will always in all questions apply. Now let's talk about certain protective duties. Now duties can be revenue duties or protective duties. What do we mean by revenue duty? The normal duties, like whenever you are importing certain things, government want to collect duties from you for its revenue purpose. So these are normal revenue duties levied for the purpose of raising customs revenue. But protective duties are duties which are actually not intended to raise any revenue. But say for example, certain goods are being imported. We want to discourage import of certain goods to protect our domestic industry. We want to discourage import of certain goods. Why? Because we want to protect our domestic industry. In that case, government levies protective duties. Means the idea of government, the objective of government is not to raise revenues out of it. Anyways, yes, it will be raising revenues, but that is not the underlying objective. What is the objective of levying these protective duties would be, we want to give protection to our indigenous industries. So should not be very stiff. See, understand, these protective duties should not be very stiff also, so that the imports are being completely discouraged, because to run the economy, we obviously need to do import-export activities. So we need to maintain a balance while importing protective duties, that it should not be very stiff so as to discourage imports, should be sufficiently attractive to encourage import, to bridge the gap between demand and supply. Because if we levy extremely stiff protective duties, it would discourage imports completely, and then there would be a demand supply imbalance, because demand would be more but we would not be able to satisfy it with domestic production, and also we are not importing those goods, then it will create a demand supply gap, right? What is the meaning of protective duty? See, understand, today government says that if you import furniture, the rate of duty, the basic customs duty applicable would be, let's assume, 40%, right? At any point of time, we feel that this 40% is extremely low, because furnitures are being imported in extreme quantities, and also these furnitures, because of these imported furnitures, our domestic industry is dying. Ideally, this rate should not be 40, it should be somewhere around 55% is what we think. Now, immediately I cannot increase the basic customs duty, because I need to put everything in front of parliament, get approved and everything. So for that time being in force, I will apply protective duties. See, understand, protective duty is deemed to be then specified under first schedule. Means normally the first schedule of the Customs Tariff Act gives import duty rates for all the types of HSN code. Now I cannot immediately amend it. So till I cannot amend that particular thing, and I want to save my domestic industry, I will be levying protective duties, and government would deem those protective duties to be specified in first schedule only. Means we'll be treating 55% as the basic customs duty only till the time when the protective duties are in force. So these are levied by the central government on recommendation of Tariff Commission. Like GST, we have GST Council. Here we have Tariff Commission giving recommendations with respect to rates to protect interest of domestic industries. And it would be effective only up to the date which is specified in first schedule. So these will be deemed to be specified in first schedule. And now once the notification is issued, government shall introduce the bill in the parliament during next session for continuance of protective duty. Notification shall cease to have effect on expiry of 6 months from the date of introduction in parliament if it doesn't become a law. So once I just in urgency, just to protect my domestic industry, I would be levying the protective duties. Then I will present this bill in the parliament, and in 6 months time from presentation in parliament, in 6 months time, if it does not become a law, means parliament is not approving it, then the rates will go back to 40% which were originally there. So government may also reduce or increase. See, it's not just we always increase the rate, we can also reduce the rate via notification, but in case of increase, parliament approval would always be required. So this is all about protective duties. Means protective duties, whenever in force, would be treated at par with basic customs duty only. You can understand that way till it becomes law. Once it becomes law, it will permanently be amended in the first schedule saying that now the rates are 55% only. Also, in case of certain emergency, government can always enhance or impose export duties or import duties. Government has that open power that in case of any emergency, they can levy import duties as well as export duties. Right. Now we'll study about certain safeguard measures. So central government, after conducting inquiry, is satisfied that an article is being imported into India in increased quantities, means very much, a lot of quantity is being imported, maybe let's say they're dumped. In that case, obviously there would be a tough competition going on in the domestic industry. Means you understand the entire need of India is like just an hypothetical example that if there are 40 crore cars, if there are 40 crore cars being manufactured in a year, extremely hypothetical example, that would be enough to satisfy the need of India. Now we are seeing that 30 crore cars are being already imported in India. 30 crore cars are being imported in India means the entire demand in India is only around 40 crore cars, out of which uh, every day we are increasing the imports, and the imports have reached to almost 30 crore cars. Now in this case, do we understand that our domestic industries would be in danger? Our domestic industries would be in danger. Now in this particular case, we can impose certain safeguard measures to protect the domestic industry. So here, any article, if being imported in India in increased quantities and such increased importation is causing or threatening to cause serious injury to the domestic industry, in this case, we can impose certain safeguard measures. Now, what can be the safeguard measures? Either government can fix a tariff rate quota, means government will fix a quota that this is the maximum quantity that you can import. You cannot import more than this. So in that case, government can fix this type of a quota that if you import till this quantity, then the rates of duty will be this. If you import more than this quantity, maybe we will not allow you to import, or we will levy higher customs duty, whatever. So that is simply a tariff rate quota. Or government can impose a safeguard duty or other measures, whatever central government deems fit. Now, other measures, there's no need to study. Now, let's start with tariff rate quota. So tariff rate quota means average level of imports in last 3 years for which statistics available unless different level is deemed necessary. So normally what I will do in last 3 years, what was the import of that particular product? In last 3 years, what was the import of that particular product? I will take average of it, and that will become my tariff rate quota. That now you are not importing more than this. However, if government thinks that some other level is necessary, means maybe less than that or more than that, then it's okay. Government may determine some other level also. Otherwise, normally it is always the average level of last 3 years. Now, duration of safeguard measures would be 4 years from the date of imposition. So once safeguard measures are being imposed, they are effective till 4 years from the date of importation. So within 4 years, government will do proper inquiry, and whatever ultimate permanent measures they want to keep, they want to increase the rate or anything like that, they can do that. But for 4 years, we can put these safeguard measures into place. And this can also be extended till 10 years, means 4 years plus 6 years extension can be done. Okay, but there are certain situations where you are completely being exempted from safeguard measures. So if there are articles being imported from domestic country, as I said, this is all theory, not very much relevant for examination point of view. You should just have an idea about it. No need to remember everything word to word, because majority of the times, 80% of the times, practical question is being asked from this chapter, and that I'll give you a format at the end of the chapter. So now here, articles from developing country, they are saying. So from developing countries, if a particular developing country's share is only till 3% of total imports, like say for example, if 100 articles are being imported in India from all the countries, and there is this particular one developing countries which only exports up to 3% in India, means up to 3 units in India. In that case, we will not be levying safeguard duties. Now understand, safeguard duties are not blanket duties. Like if at any point of time, any person importing a car from any particular country will levy safeguard duty, the answer is no. Safeguard duties are levied with respect to particular countries, because that particular country is exporting goods in increased quantities to India. So in that particular case, we are saying that for any developing country, if that particular developing country's share does not exceed 3% of the total import, we will not levy safeguard duties. Or let's say, if we are importing from more than one developing country, in that case, the aggregate of all developing countries should not exceed 9%. See, understand, if there are 5 developing countries from which we are importing, the country A's share is 1%, country B's share is, let's say, 5%, C's share is 3%, Four's share is 2%. Now, in this case, the aggregate of all has exceeded 9%. Now, even if this particular country is having a share of less than 3%, safeguard duty will be levied on all. So, both the simultaneous conditions will have to be fulfilled. That a particular country's share should not go above 3%, and the aggregate of all developing shares developing countries should also not go beyond 5%. If any of these conditions is being breached, then we can levy safeguard duties. Or if there is a 100% EOU or in a special economic zone who is importing, so imports by 100% EOU or special economic zone units, they are being exempted. But if government specifically wants to make applicable, see, normally whenever safeguard measures are being put in place, these people will be exempted. 100% EOU people or SEC units will be exempted. But if government specifically wants to apply that, no, even if an EOU is importing, then also we want to levy these duties, then government can specifically make those duties applicable to them. Or an article imported which is cleared in the domestic tariff area. Obviously, we understand that EOU or SEC unit have to make export. For that reason, only we are giving them these exemptions. If in any case they decide to clear it in domestic area, then we will levy duties on them also. You have to remember this specifically, because for all the upcoming duties, you will find this common exemption saying that these duties not applicable to this particular people. So sorry. Yes. Okay. Now, can safeguard duties be provisionally levied? Because we are not sure whether actually the goods are being imported in increased quantity or not, actually if it's causing the threat or injury to domestic market or not. In that case, yes, you can provisionally also impose safeguard duties and then finalize it later. However, provisional duty can be maximum imposed for a period of 200 days from the date of imposition. If you anytime want to modify any notification, you can just by laying before each House of Parliament and getting it cleared for a total period of 30 days. So this was all about safeguard duty. There's nothing technical in this. You only have to remember that whenever the goods are being imported in increased quantities and it is causing damage to our local market, government can either impose a tariff rate quota, or government can say that we will levy 20% safeguard duty. So that then in that case, along with basic custom duties, safeguard duties will also become applicable. That is it, what is relevant for question answers. Now, other than that, it can be levied for a period of 4 years, extendable till 10 years, provisional imposition also possible, not applicable to certain people. That is all theory, which you can just read and let go. Now, let's talk about countervailing duty on subsidized articles. What is the meaning of this? Now, say for example, let's continue with the example of calculator. So here, if there's a particular country telling to its own people that if you manufacture and export calculator, we'll be giving you subsidies. So what that government is doing, that particular country's government is giving them super heavy subsidies, making those particular goods extremely cheap for them. So now if they export those goods to India, obviously the transaction value would be extremely low, because their government is giving them subsidy. Now, in this case, what our government can do is increase the rate of import duties. So, any country or territory, directly or indirectly, pays or bestows subsidy upon the manufacture or production or exportation of certain articles. Such subsidy includes subsidy on transportation also. Such articles are imported into India. The importation may not directly, see, understand, it is not necessary that I directly import from that country. They can also they can also change the origin, which is okay. We will still be in a position to levy countervailing duties, and the article may be in the same condition as when exported from the country or manufacturer, or maybe changed condition also. So they just to hide the identity of the article, they might even make certain changes in that particular article. So simply we are saying their government is giving them subsidy so that they can manufacture those goods and export it to us. their government is giving them subsidies specifically to manufacture and export those goods to us at a cheaper rate so that our economy collapses. In that particular case, we can levy countervailing duty. Now, what will be the value of countervailing duty? It will be the whatever subsidy their government is giving or whatever is the injury margin, whichever is lower. Now, what is the meaning of injury margin? Wait for 5 minutes, we'll discuss the same. Now, ways that constitute circumvention of CVD: by altering the description or name or composition of article, by import of such article in unassembled, disassembled form. So what normally people do to circumvent CVD means to escape from CVD. They either change the description or alter the name of the product, or they start importing it in an unassembled, disassembled form. They try to change the origin, or in any of the case, they do certain things which essentially render the duty ineffective only. So in all of these cases, government can specifically still make the duty applicable to you. So you are saying, no, we have not imported calculator. We've imported buttons. We've imported the body of the calculator. We've imported the cells. We're just going to assemble it here only. Now government says, if you try to circumvent these countervailing duty by any means, by altering description or by importing in unassembled form, by trying to change the origin, in all of these cases, government can still extend the countervailing duty on you, not earlier than the date of initiation of the injury. So as soon as the injury starts, government can always impose the duties to you. Now, absorption of CVD. What is the meaning of absorption of CVD? See, understand. If their government had not given them subsidy, the goods were to be manufactured for 100 rupees. But their government specifically gave them subsidy so that they can manufacture it at an extremely cheaper rate and then export it to us. So because of subsidy, the goods became worth 70 rupees. So we understand that there is this subsidy margin of 30. Now government levied 30 as countervailing duty, making the value again to 100. Their government understood that our government, Indian government, is levying countervailing duty of 30. What they try to do, they try to give more subsidies. They give additional subsidy to their people. They started giving 60 rupees subsidy. So now the goods are being manufactured only at 40 by their exporters. Now in this case, as we add duty also, still it will remain 70 only. So if in any case their government is trying to reduce the export value more by giving more subsidies, we can also increase our countervailing duties. So here, if there is a decrease in export price of an article without commensurate change in the resale price in India of such article imported from the exporting country, means export prices decreased. Export prices only decrease, but there's no decrease here, which means the entire CVD is being absorbed. Under such or other circumstances, government on such inquiry, as it considers necessary, is of the opinion that there is absorption being taking place, they can anytime increase the countervailing duties. So we may modify such duty to counter the effect of such absorption from such date, not earlier than the date of initiation of injury. So whenever from the date when injury is initiated, from that particular date, we can also increase the countervailing duty. Again, it is not applicable to 100% EOU, as I've taught you, unless specifically made applicable or cleared into domestic tariff area. Provisional imposition possible? Yes, possible, but if in any case provisionally we have collected more taxes, we can refund the excess to the importers again. Retrospective imposition? Yes, allowed, obviously. Allowed from a prior date, but not beyond 90 days from the date of notification. So is retrospective imposition of countervailing duty allowed? Means we later got to know that their government is giving subsidy and we want to levy those duties from a retrospective date. Yes, we can, but whenever we are coming up with the notification to levy those taxes, at the max 90 days prior we can go for retrospective imposition, not more prior to 90 days. Temporary revocation? Yes, possible, but not exceed 1 year at a time. Duration here. For safeguard measures, we've studied 4 years plus 6 years. Here it is 5 years plus extension of 5 years. Total is 10 in both the cases. And if the duty is under review on expiry, in that case, it shall continue to remain in force pending outcome for a further period not exceeding 1 year. Means originally the duties were imposed for 5 years. But still the duties under review, we have not been able to finalize it or some proceeding is going on. It is okay, we can extend beyond this also. but not more than 1 year. Whatever conclusion you want to arrive upon, please complete it in the 1 year after the expiry of the time limit. Right. So in short, if I want to tell you what is countervailing duty, countervailing duty simply says that if their government, if the exporting country's government is playing games, it is giving them subsidies so that they can manufacture at an extremely cheaper rate and export it to us so that our economy collapses. In that particular case, we can anytime levy countervailing duty. Now, what will be the maximum amount of countervailing duty? It would be subsidy or the injury margin. Now, what is injury margin? I'll teach you along with anti-dumping duty. See, injury margin means fair selling price minus landed value of the imports. Means, what is the injury to us? Means normally if I manufacture these goods in India, I can do it for, let's assume, 170 rupees, right? What is my, if I import, I will have to pay assessable value, plus I will pay basic custom duty, plus I will be paying social welfare surcharge, right? Do not include GST or any other special duties, because GST would be applicable if I manufacture the goods in India also, or if I import then also. So all these CVDs are the duties which are applicable in domestic as well as imported, both categories. And also if there are some other special duties, like safeguard duty or anything, now that is in a specific case, just to counter effect some other thing. Therefore, exclude that. So only and only CIF value, which is the assessable value under customs, plus basic custom duty and plus social welfare surcharge. This is the amount at which I am importing. So say for example, if I today manufacture in India, the fair selling price would be 170. But if I import those goods, then let's say importation is taking place at 120, plus I am paying 15 rupees as basic custom duty and 1.5 as social welfare surcharge. Now in this case, 136.5 is my entire landed value under imports. So do you understand that the domestic industries are suffering an injury margin of 170 minus 136.5, which is 33.5. So there is this injury margin of 33.5 taking place in every single product, because people would obviously consider buying the cheaper product and not the Indian manufactured product. So they are saying that what CVD I can levy maximum. So 33.6 or whatever, 33.5, whatever was the injury margin taking place, or what is the subsidy that their government is giving. Let's say their government is giving 20 rupees subsidy on every article. Whichever is lower will be the maximum countervailing duty, which is 20. Now see, understand, countervailing duty cannot exceed subsidy. Now today, if they are able to manufacture goods at a lower of 13.5, now that is their efficiency, right? That is their efficiency, that the same goods that we are manufacturing for 170, they are able to manufacture at 170 minus 13.5, even after levying all basic custom duty and everything, it is for 156.5 only. Now you cannot levy taxes for their efficiency. We can levy taxes maximum till what subsidy government is giving, or if in any case their government is giving subsidy of 40, but our domestic market is suffering only by 33.5, then okay, let the government give subsidy, because anyways after giving subsidy also their goods are costlier, because our injury margin is only this. So whatever will be the lower will be applicable as countervailing duty. So whatever subsidy the government is giving, or whatever is the injury margin. Injury margin means what injury our markets is facing, means the landed value from there, the CIF value plus the basic custom duty and plus the social welfare surcharge. So whatever is the landed value, you will compare it with the Indian fair selling price. The difference is injury, and compare injury with subsidy. Whichever is lower will be the countervailing duty. Now talking about anti-dumping duty. So here, the exporters of a particular country try to dump the goods into India just to capture entire market. So normally, if let's say example, there's an exporter of TV. Now that particular person in its home country is selling the TV for, let's say, 70,000 rupees. But just to capture entire market of India, it decides to sell this TV in India only for 25,000 rupees. Once he wants that all the Indian players are out, because he is able to sell the TV at such a cheap rate, all the other players in the market would be out. He'll create a monopoly in India and then start increasing the prices. So here, if in any case, any exporter is dumping their goods at less than normal value, in that case, we will levy anti-dumping duty to protect our domestic industries. So what is the meaning of dumping? So the normal value in their own exporting market is some other greater than the export price. Means normally that particular TV in their home country is only sold for 70,000, but exporting for 25,000. How is this possible? Means simply they are trying to capture the market. They are trying to dump everything into India. In this case, we'll be levying anti-dumping duty, and again, anti-dumping duty would be what is the dumping and injury margin, whichever is lower. As we in case of countervailing, we saw subsidy or injury margin. Here we'll be seeing what dumping they are doing, comparing with the injury margin, whichever is lower. So margin of dumping means, what is the margin of dumping here? What is the normal value at which they are selling in their country? It is 70,000. What is the export price? 25,000. So the difference of 45,000 is their dumping being done. So dumping normal value minus export price is the margin of dumping that we are going to compare. With the injury margin. Injury margin already taught you. Fair selling price means in domestic industry in India, and the landed value at which we are importing. So by this we are going to arrive at the injury margin. Compare it with the margin of dumping. Dumping means normal value, means the selling price of article in domestic market of the exporting country or for other countries. Other than India, in other countries it is exporting for, let's say, 70,000 only or 60,000 only, but in India it is sending for 25,000, means that is the margin of injury. So whatever is the selling price in their domestic industry, if not available, take to any third country at what price it is exporting. Even that is not available, then what is their cost of production or some general expenses that they incur, and adding a reasonable profit. This should be ideally the price. Why they are selling it for less than this particular price? Because they want to dump. They are incurring losses and still selling those goods in India. And export price, understood, that price of the exported article, if not available, price at which imported articles are first resold to the independent buyer. Now normally in all cases export price would be available. If in any case export price is not available, then after importing, what is the first value at which we sell to some person to an independent buyer in our domestic market? That we'll take as the price. Yes, so this is all about. Now again we understand that there can be circumvention, same as section 9. You can try to import the goods in unassembled form, try to change the origin and everything like that. In that case, we will still levy those duties on you. Date of commencement would be the date of publication in official gazette. Provisional imposition, yes, possible. Later will refund if charged in excess. Retrospective imposition, again possible, not prior to 90 days. Temporary revocation, again not exceed 1 year. Duration would be 5 years plus 5 years. So everything under anti-dumping duty is same as countervailing duty, word to word. Nothing is different. If it's under review, then you get the additional time of 1 year. Every single thing is same as countervailing duty. Now in any case, this also is same, that anytime if duties were paid excess, then it's okay, we'll be refunding those duties to you. No levy under 9 or 9A. Okay, this is kind of little bit important, saying that no countervailing duty or anti-dumping duty would be levied when, first of all, for one particular article, you cannot anytime levy both countervailing and anti-dumping duty. Any one of the two will be levied. So for one single article only, you cannot levy anti-dumping as well as countervailing both. Any one would be levied. Second, countervailing and anti-dumping duties shall not be levied just because articles are exempt in that country. Now understand. Let's take an example of salt. Now, salt is anyways exempt in India, right? Salt is anyways exempt in India, considering it as a necessary goods. Government anyways gives a lot of benefits or subsidies to the people who are manufacturing salt. Now, in this case, if that is the case, that a particular good is exempt in that exporting country, there we cannot say that their government is giving subsidies, because there also it is exempt. If it is exporting, then also they are getting those benefits. Then that cannot be considered as a case of dumping or as a case of their government giving subsidy only for export. So countervailing or anti-dumping duty shall not be levied just because a particular article is exempt from duties in that particular country, because then it is equal to them. Then they are not specifically doing it for export purpose. It is anyways exempt all the time. All these duties shall not be levied on imports from a member country of WTO. Now understand, if we have a most favored nation or member country of a WTO, World Trade Organization, in that case you cannot just simply stand up and start levying these duties. You will have to prove that yes, these particular goods are actually threatening. Material injury is being threatened in India then only you can levy those duties. Otherwise, what is the purpose of World Trade Organization? If any country can any day start levying such high rate of duties, then what will be the, how will be trade facilitation done? So if most favored nation, or so like we have an MOU with most as a most favored nation, or we are a part of World Trade Organization, that country is a part of World Trade Organization, you cannot simply start levying these duties just because you have a doubt. Then you will have to prove that yes, actually that country is doing that particular thing and our domestic industry is being threatened. In that case only you can levy these duties. They are not saying no, they're just saying proof. Provisional countervailing anti-dumping duties shall not be levied on any article imported from specified countries unless preliminary findings are fine. As I said, you can levy provisional countervailing duty, but do not levy it just like that when you don't have an evidence. If there are those specified countries with which we have MOU, which are part of World Organization, then in that case you levy duties only after you can prove something. There is some preliminary finding available with you. Point number B, C and D mentioned above shall not be applicable in case where countervailing or anti-dumping duty has been imposed on any article to prevent injury or threat to the domestic industry of a third country exporting the like articles to India. Means here we are saying, let's say country A and country B, both of these countries are exporting goods to India. Now in this case, country B is a most favored nation or a part of World Organization, country A is not. This country is causing material damage to our domestic market. We are saying, okay, you can continue levying duties on this, because these countervailing duty and anti-dumping duties are not general duties. That if any person is importing TV, we will levy these duties. The answer is no. If import is being done from that particular country which is dumping here, then we are going to levy duties. So they are saying that if a matter is going on with one country, it shall not affect anything going on with other countries. You continue levy your taxes with other countries, what you are doing. See, basic custom duty is a flat blanket duty. Any person importing TV from any damn place, basic custom duty will be applicable. When we talk about countervailing duties or safeguard measures for that reason, or let's say these countervailing duties, anti-dumping duties, these duties are specifically levied when any country is dumping or providing subsidy in that case. So here we are saying that if you are dealing with some another country, let that continue as it is. Okay. So this was all about the types of duties as such. What we studied: basic custom duty levied on all imports export, understood. Then all the types of countervailing duties just to balance GST, excise, sales tax, compensation cess, everything. Then we saw protective duties. Protective duties are just like basic custom duties only. In all cases, treat protective duties as basic custom duty only, because we cannot immediately increase the basic custom duty just to prevent the injury. For short period, what we are going to do, we are going to levy protective duty, which will always be at par with basic custom duties only. And then we saw safeguard measures, countervailing duties, and anti-dumping duties. So safeguard measures simply says that if imports are being done in increased quantities, we can either start applying the tariff rate quota, or we can apply the safeguard measures. In case of countervailing duty, if that particular country is giving subsidies, then in that case, subsidy or injury margin, whichever is lower, will be the duty. And for anti-dumping duty, margin of dumping or injury margin, whichever is lower, is going to be the duty applicable. Right. Appeal can be preferred, yes, in CESTAT, which is Customs, Excise and Service Tax Appellate Tribunal. If at any point of time you feel government is harshly levying duties on you, there is no dumping, still government is levying anti-dumping duty, you can go and file an appeal in the CESTAT, which is Customs, Excise and Service Tax Appellate Tribunal. And with a fees of 15,000, you are going to make application. Every application made before CESTAT in an appeal for grant of stay or rectification of mistake or for restoration, fees will be only 500. Now, if you are going for a fresh appeal application, you file a fees, you pay a fees of 15,000, but you only want to rectify certain mistake, or there is any other mistake being taking place which we want CESTAT to rectify, or for restoration of an appeal which you had filed earlier, the fees would only be 500 rupees, and appeal to be filed within 90 days from the date of order. So whenever proper officer gave you the order to pay anti-dumping duty, within 90 days or plus any extension that may be allowed by CESTAT, you have to go and file this appeal. Now, social welfare surcharge, as I said, but specifically circle imported goods 100 times, 10,000 times, I don't know, let your page get dead, but make sure that you know that social welfare surcharge is being levied on basic customs duty always only and only on all imported goods, not on any exported goods. Social welfare surcharge will be levied. Now, whether the question specify or does not specify, you always have to levy 10% social welfare surcharge without question mentioning it on imported articles to fulfill commitment of government to provide finance, education, safety, and health and social security. Like under Income Tax Act, we have this health and education surcharge. Similarly, in customs, we have this social welfare surcharge. Then we talk about agriculture infrastructure and development cess on import of certain items. If there is a notified item, just for an example, gold, silver, kabuli chana, apple, all of these products, government levies an additional tax named as agriculture infrastructure and development cess. Now nothing is given more than this. Module only says this, that on particular notified goods, that also not in our syllabus, these 4-5 names given in module I have reproduced. If at any point of time question wants you to calculate this tax, they will have to specifically tell you that this is a notified good and please levy agriculture duties on the same. You can levy the duty whatever the question says. So here, when levied at any percentage of value calculated, so whatever will be the original assessable value on which you levy basic custom duty, on that original value only you will be levying this agriculture infrastructure and development cess. And for what purpose this cess is going to be used? To improve the agriculture infrastructure and other development expenses. Done. So this is all about types of duty. Now you would have found a lot of duties being involved here and you might think that it is going to be confusing, but trust me, it is the most simple chapter. Pray to God that question from types of duty comes in examination, and using this format you will be able to solve question and you're not going to lose even a single mark in same. See, what will be the format? So first of all, we start with the assessable value. We always add basic custom duties, and as I said, protective duty is just like basic custom duty, a temporary increase in basic custom duty. So whatever protective duty question specifies, you add it along with basic customs duty only. Then we make a total. Now, if there is any CVD to be imposed for excise, CVD under section 3(1) is the CVD for excise, which is levied only on alcoholic liquor, petroleum products or tobacco for the products in which for which excise is still being continued. So on this total A, assessable value plus basic custom duty plus protective duty, on this total you levy CVD under section 3(1), whatever CVD the question specifies for excise. You again make a total and now you levy social welfare surcharge. Now do we understand, social welfare surcharge is not levied on the original assessable value. I've taught you social welfare surcharge will be levied on basic custom duty. Why? Because normally in 99.9% of the questions, you are not going to see protective duty, you are not going to see countervailing duty under excise. So what you are left with is basic custom duty and you levy 10% on this basic custom duty. But if you want to go to extreme details, what would be the last possible case would be if all the types of duties are present in the question, you levy social welfare surcharge on basic custom duty, and whatever is levied on basic custom duty will always be levied on protective duty, because protective duty for time being is deemed equivalent to basic custom duty only. So on BCD and on protective duty plus the countervailing duty of excise, the CVD under section 3(1), on all of these three duties, I will be levying 10% social welfare surcharge. I again make a total, and now whatever is the GST or whatever is the sales tax, if there is a sales tax case, if there is a countervailing duty to balance the sales tax, on this entire total I will be levying, to counterbalance the effect of VAT, I will be levying CVD under section 3(5). Now safeguard measures, anti-dumping duty and CVD on subsidized articles. Now do we understand, all the duties are in percentage format, but for anti-dumping duty and for CVD on subsidized article there is no percentage. We get an absolute value comparing with what is the injury or what is the dumping, what is the injury or what is the subsidy. We compare those amounts and we get an absolute figure. So this will be an absolute figure, means this particular percentage you are not going to apply on anything. You will get an absolute figure of duty. Just write that percentage. But for safeguard measures, they might give you percentage in question, saying that levy safeguard measure at the rate of 20%. Now in that case, safeguard measure will always be applied on the original assessable value. Forget all other taxes. If the question is saying 20% of safeguard, 20% is the safeguard duty. if the question is saying 20% is the safeguard duty, then you have to levy this 20% on the original assessable value. Forget about all duties and taxes. Do not levy safeguard measure of on any of the other duty or taxes. Now you make a final total, and we know on all types of taxes CVD under GST will be applicable, because the value of supply chapter of GST also says that there is any kind of tax being levied, you levy GST on the same. So here IGST will be levied on this total E, and also GST compensation cess, and here I get my total value, which is assessable value, plus all the duties under customs. So this is the format that will help you. Now, rarest of the rare chances that they ask you in question. Now, they might ask you, let's say in the question number 6C or 5C, to explain what is countervailing duty, but still chances are less. I would say 80% you should expect a practical question from this chapter only if the chapter comes up, and that question you can solve using this numerical format.